This is the first lesson in Accounting 201, Introduction to Accounting Information. At the end of this lesson, you will be able to explain what accounting information is and how its standard formats help people make decisions. You'll be able to create some examples of who uses the information and how they use it. You'll be able to identify the types of data that are included in accounting and conversely what types of data are not included in accounting information. And you'll be able to tell the difference between events that we account for and events we do not account for. Don't forget to take the online quiz after listening to this PowerPoint presentation. What is accounting information? It's financial information presented in certain standard formats called financial statements. In Accounting 201, we'll learn about balance sheets and income statements. In Accounting 202, we'll teach you about the statement of retained earnings and the statement of cash flows. Accounting information is data presented in a certain format called financial statements. One of the important points to understand early in any accounting class is which data is included in financial statements. Knowing which data to capture is very important to the organization. Some examples of things that are included in accounting are the results of selling goods or providing services, incurring costs, whether we're ordering inventory, paying our employees, renting, signing a lease to rent a building, paying rent, paying employees, paying the insurance, paying the utilities, or borrowing money. These are all examples of transactions that we're going to learn to account for. It's certainly true that some things that a company does do not enter into the accounting data. Some examples of things that do not get accounted for are hiring a new employee. Hiring someone becomes accounting information once they work and we owe them money. We do not account for signing contracts. For example, signing a contract with the cleaning service. If there's no exchange of money, there's nothing to account for in the signing of the contract. If the cleaning service provides cleaning, we would account for that. If we pay them before they do any cleaning, pay them in advance, we would account for that. So that's a sort of a tricky area, something that we're going to have to understand in more detail as the class goes on. How do we know whether to account for something? Accounting information always involves quantifiable data. If you can't not turn the information into a dollar amount, it can't go into the financial statements. So you hear companies talk about things like their biggest asset is their employees. Well, in our country, we do not assign dollar values to people. That's not quantifiable, so that's not accounting information really. Data has to relate to exchanges of value, not simply the promise of future exchanges of value. I promise I'm going to come to your restaurant next week to eat. Well, that doesn't do anything for the restaurant, right? Assuming that you didn't give them payment in advance for the dinner, and assuming there's no payment for a failure to show up for your reservation. Simply making a reservation as a promise to come and eat at your restaurant does not have any accounting implication for the company. So this is also something we're going to learn more about as we go along. So your natural question should be, what's a financial statement? These are the sets of information people use to evaluate what a company's doing. A financial statement is a set of information where the data or the information presented in a certain predictable format helps people understand the information. Companies are required to use standard formats. This is true whether it's a U.S. company or a company in any country. But in the United States, the formats are very specific, and those are the ones we're going to learn in this class. Standardization of information is pretty important if you're going to try to use information. It makes makes differences between companies easier to spot. It helps all companies ensure that they disclose similar data to all their competitors. It prevents the data and the results from driving the disclosures. So if you get some negative results and you might want to hide it, you might tend to alter the format. But if there's a predictable required format for the information, you can't hide those negative results as easily. And most importantly, having standardized financial statements helps the users of the information. They can anticipate certain content. They can learn to analyze the financial statements in a predictable way, as we're going to in this class. If there was no standardization of information, users would have a very difficult intellectual challenge. Think of the difference between the list of courses you've taken in college and a college transcript. The list of courses could be done alphabetically. The list of courses could be done in the order you took them. The list of courses could be done by the college you took them from. The list of courses could be separated into a GPA for every year in college, or overall, or in your major, or just in your science classes, or just in your business classes. There are limitless ways to display data depending on the message you're trying to convey. What standardizing your college information does for you is allow you to have a transcript to give to every potential employer or graduate school, and they understand a transcript. They know what they're looking for. It'll show your name and your personal identification information. It'll show courses you took and grade points. It'll show combinations of courses taken in each semester and the grades you earned. Having the information standardized helps people use the information more efficiently and effectively. One type of standard format of information we're going to study in Accounting 201 is the income statement. Some people call it the net income statement. It shows two categories of information. Revenues are the amounts the company earns, and it helps identify what the company does to earn the money, whether it sells goods or provides services. Revenues could come from profitable investments. There are different sources of revenue for a company. There are also a lot of different kinds of expenses for a company. Expenses are the costs the company incurs to enable it to earn the revenue. So if we're going to earn money, let's say in our restaurant, we have employee costs. We pay the employees, we give them benefits, those have costs associated with them. We have office costs for our company, buildings, utilities, rent, maintenance. We had advertising costs, we might have vehicle costs if people get company cars or our salespeople have access to a car. We have insurance costs. All kinds of different costs are expenses. We're going to learn how to make income statements that show this information in such a way that allows people using the income statement to tell how you earn your money and how much cost was associated with earning that money. Another kind of standard format we're going to learn to prepare in this class is the balance sheet. The main categories on a balance sheet are assets and liabilities and equity. A balance sheet shows what the company owns. The kinds of things are listed. Is it cash? Is it cars and trucks? Is it equipment? What kinds of things do you own? And what's the dollar value associated with those things? How much did you pay for those assets? A balance sheet shows that category. A balance sheet also shows liabilities. Who are the groups of external people you owe money to? You might owe money to your employees from work that they did last week that you haven't paid them for. You might owe money to suppliers, people who bring the food to your restaurant that you're going to serve customers are the suppliers. Maybe you owe money to the bank. Liabilities are all the people you owe money to. All the groups are shown and how much you owe each group. And we'll find out that there are details about assets and liabilities like how soon you owe the money that become very important in the preparation of a balance sheet. Equity is the difference between assets and liabilities. So, if your only asset is cash and you have $1,000 in your bank account, but you know you owe the rent of $800 next week, your equity would be $200. Equity is simply the excess of assets over liabilities. So I've been talking about standard information and users of information. So who's using accounting information? And the answer really is everyone. You probably use accounting information already without realizing it. Look at some of the examples on this slide. Do you use your cell phone app to check the price of a product at a different store when you're shopping? Do you look in the newspaper or look online to find out which days the movie theater offers a half-price popcorn? Do you shop around for the best deal on a new car or a car that's new to you? A company might have to decide things like how many cooks they need on the late shift at their restaurant. That's a use of accounting information. They might have to decide whether it's profitable for the restaurant to stay open an hour later on Saturday evenings. That's a use of accounting information. There are lots of different detailed uses of accounting information that we're going to learn about in this class.